Good afternoon, everyone. Welcome to our today's class. We're going today to talk about importance of technical indicators in our whole trading process. During the previous sessions, we covered most of these subjects, but now we're trying to compose them into one thing. So once we have picture completed, then I think we'll be ready to start moving towards trading. So importance of technical indicators, as the topic says, the technical analysis itself, which is studied and should not be mixed with the technical indicators, which are just part of that study, because technical analysis includes trends, trend lines, all the patterns, candlestick patterns or chart patterns, indicators, while the indicators itself are one part of it, and each have purpose of giving us certain indication about price action and movements. So a combination of these things will give us the most useful and the clear picture, so it will help us greatly in making our trading decision. It's important to mention, and we already spoke in details about actually all famous, the most famous or popular technical indicators. It's important that this is a good and big part of trading plan and trading action, and this should not be ignored, because this gives us a quite good indication. It has nothing to do with the fundamental analysis. It's the study on its own, and it's based purely on mathematical calculations. So each indicator has certain formula and calculation, which uses, all of them basically use the same parameters. So they use the price and the time and the volume, and based on this we have indication about price movement of the price of our chosen financial instrument. So starting with the technical indicators, as we said, they are tools that help us defining the market direction, that we can generate through the indicators trading signals, changes of the direction of the market, reversals, and in order to start our preparations, we need to analyze the market. This is what I mentioned in the several previous classes. So analyzing is getting knowledge about the market movements, about chosen financial instrument, about its behavior during a chosen periods of time. Also, when we analyze, we have to check various time frames in order to have complete picture, because the instrument could be in a long-term downtrend, but if we check the lower time frames, then we can find that it's in corrective action and basically in uptrend. So we have to have all these parameters done and the evidence of every movement. So analyzing the market before making any trading decision is the most important, one of the most important things in approach to trading. And traders, usually what they need to do is to choose the financial instrument that is active, it's liquid, it shows certain direction, has the volume and volatility. So all these things that are helpful in trading, that can move the price faster. So we don't want to trade about something which has a range of 15 pips maybe, and is in the almost a straight sideways line. So it's not our target. We're looking for a liquid instrument. So when we choose it, we have to see what I previously mentioned, the direction of this financial instrument. It's called trend. So we need to define the trend and to see direction of the trend. So is it uptrend, downtrend, or it's sideways trend? Three types of trends that we already mentioned in our previous sessions, and through the indicators we can recognize the strength and the length, potential length of this trend. If most of all indicators are showing in pointing in certain direction, and they have certain parameters that are pointing to the strong trend. So it means that this trend is likely to last for some period of time. So we have enough time to keep our position and probably to gain some, generate some more profits, since we already defined the trend and ready to jump into it. Using indicators is also a tool that could help us to find important points in the price action. These are the most important support and resistances, and we can define also our entry and exit points, our stops. So everything that is relevant and crucial for trading, we can, in assistance with the technical indicators, we can find these points and put them in our trading plan. So we have already prepared ourselves for trading. So once the indicator starts pointing a certain direction, we make the trading decision and jump in the market, hoping that we are going to catch the trend. There are plenty of technical indicators in the market, hundreds or thousands available. It's quite a challenge to choose the proper ones, but let's talk about the most important, those that are the eldest and existing for a quite long period of time in the market. So during this period, these indicators were tested and retested and prove their reliability. So it is always better to choose something that it's reliable, it has background, it has history, it's been proved, rather than experimenting with something that is new. I'm not saying to ignore it completely, but we feel more safe when we deal with something that is in our territory, that which we feel comfortable. So we understand the performance, we understand behavior of this indicator, and most of traders use them. So we're going to stick to those that are the most popular in the market, most commonly used, and I don't think it will be anything wrong with this, especially with the new traders that need to learn about this. And the things that you will hear mainly are these indicators that are the most popular and well known among the traders. If you open just Google it and put the economic indicator, technical indicators, then you will find the list of it. Or if you go to the trading platform and go to the market, then you will see hundreds of indicators that you can download. And if you use too many in one chart, that will be just confusing. I was seeing in my career people that put 10 to 15 indicators in the chart, and it looks like Spider-Net. Simply, you cannot read anything, you cannot understand anything. So let's make the life easier. We'll use those that are the most popular, accurate, proved, tested, and will give us quite reliable and good information before we make our trading decision. So the two main groups that we can put our trading indicators are leading and lagging indicators. Both of them are following the market direction, but leading indicators is the one that leads the price movement. So leading indicator will give you an indication before the price action starts changing its direction. So you will have enough time to prepare yourself if you are, let's say, in an uptrend and one of your leading indicators starts turning to the downside. So this is your initial signal, and a leading indicator precedes the market action. So you have signal in advance. So you have time to prepare yourself to probably exit your long position with the maximum profit, and then wait for a price action to start moving lower, and then possibly either to wait for correction or jump into the corrective action for some shorts. This is again recommended to more experienced traders to take the maximum of the market move. But the leading indicator will give you the indication before the market, the price action starts moving in the opposite direction or starts changing the trend. and this is quite useful. The most popular are RSI, Relative Strength Index, MACD, Moving Average, Convergence, Divergence, Stochastic, and Ichimoku studies. On the other side, we have lagging indicators. The word lagging says they lag, they follow the price action, and the signal is generated after the price reverses. After the price reverses or changes direction, so lagging indicator just confirms this change of the direction. And I would say that moving average cross over is one of the lagging indicators. Recall we talk about moving averages, and we are going to do them again today. So when the price starts reversing from initial direction, the two fastest moving averages will make, if it's uptrend and changing direction, they will make cross, but the cross will occur once the price already moves towards the downside. And now these two groups are, let's call them two big or main groups, and then we have other groups that are important, and they are basically grouping the indicators by their purpose. So some of them are pointing for a trend, some of them are pointing to the strength of the momentum volumes. So we can divide them into other groups, and it is the way that we are going to apply them in our charting system, so we will know which indicator will give us more accurate signal for trend or volatility or volume in the market. So the first to mention are trend indicators. So as we said at the beginning, we need to identify market direction or trend, and these indicators will help us used in various time frames, always giving accurate results. And basically what they do is to eliminate some ticks that are out of the range due to volatility of the market, and they are so-called noise. So we just eliminate these ticks that could confuse us, because let's say if you have an uptrend and the trend line and several ticks below the trend line, but without clear break, so it's called noise. Everything that comes out of the prevailing direction and prevailing parameters of the price action is called noise. So trend traders usually always actually use these indicators, so they help us help them to define the direction and see the potential length and strength of the trend. Moving averages are among trend indicators. Moving averages, convergence, divergence, MACD, and the linear regression, as well as ADX indicator, are among the most popular and the most used. So trend is important. We were talking previously that we look for following a trend as the safest type of trading, because any move against the trend could be quite risky, especially if we are beginners. Then we could easily bring ourselves into the situation when we will not know what to do, and it will be struggle to not just to save your position, but to save or your entire deposit if the market goes in the wrong direction, meaning that if you are going against uptrend or against the downtrend, then your deposit will melt very quickly and very easily, and then you will find yourself in the very bad situation. And we're trying exactly to avoid this. So trend indicators will help us. Just to mention what we spoke in the previous two classes about risk, this is also in a way related. So once we have the risk limited to the minimum, we can also put in our risk policy that we are following the trend only. So we are not going against the trend in any case. We are not catching the correction or something like this. So it will again greatly reduce, and the trend indicators will help us to reduce the risk to the minimum and turn our focus towards the profits, which is of course our target. Everyone who trades wants to make profit, so we're trying to find the best way the safest way using all the available tools in the market. So once we have a clear picture, then we can focus on making our profits. The next thing, the group is volume indicators. So it measures total number of, let's call it units traded during the given period of time. It's especially popular among the stock traders as gives a good indication. But also volume confirms signals from other type of indicators. So if one indicator shows reversal, then the volume and starts moving in the opposite direction, then the volume is likely to increase. There is a very common picture that we can see when there is strong market movement. It's usually followed by very high volumes. So move is basically market moves on the principles of supply and demand. So if there is strong demand, let's say, then the market will be going higher, and meaning that big number of traders are jumping into the market and bidding, buying, trying to buy the instrument. So this increases volume. So this gives us indication that a rising volume is a good signal for extension of the market direction of the trend. So it's indication that will help us to make our trading decision. I need to mention that many times happens when there are so-called thin markets, when there are low volumes. This especially happens I would say close to the end of the main US session, let's say, or during the holidays, especially when some markets remain open, but volumes are low. So you have a number of people out of trading for their holidays, but the market is regularly open. So anything that comes, volumes are low in this case because there is a very much reduced number of market participants at that time. So if any stronger bid comes in the market, then the price will jump suddenly and strongly, but will not be followed by volume because the market is already thin. As we said, small number of traders, small low volumes. So if you come and bid with the 100 or 200-300 lots, then the market will jump crazy, like crazy, just based on this bid. But usually these moves are short-lived, and usually the market price quickly returns to the original levels, but you have to be aware of these things because it could be dangerous, could be tricky. Sometimes you can see the sudden jump in the market, and you don't know what is going on. Other thing is so-called thick finger, when the market makers or brokers enter the wrong number of lots in the order. It happened, I think, last year, and there was a case in the media that suddenly moves the market. I think it was during the Asian session with the low market volumes, and the market just shoot up like crazy. This is a reaction that happens during the low volume, but generally when the market moves in a certain direction and the move is followed by rising volumes, that means that the move is healthy and is likely going to last and extend further. The third important group is momentum indicators. Momentum gives us a signal of the strength and velocity of the market movements, instrument movements. So once let's say you have slingshot and you launch one small stone, it's going to go fast at the beginning because it has a strong momentum gain from the slingshot, and is going to go into the air for a certain period of time. Once it starts losing the speed and losing momentum, it will first thing, it will be losing speed. The second thing will be turning it to short sideways mode, and then it will start moving down. So a momentum indicator will give us a signal when the price is having either strong momentum or weakening momentum, or it's giving a signal that the initial direction may change. So momentum indicators are momentum and relative strength index are the most popular. It gives us the indication, as I said, of strength of the market movements, whether positive or negative. So positive momentum indicates that the market is bullish and buying is preferred, while negative or bearish momentum suggests selling of the asset. These are fall in the group of the oscillators that have either a baseline or they have two lines and they fluctuate above or below, and we will see in our chart how it works. So I would like now to show you how we can apply all these what we spoke about during the class, how we can apply it on the chart. So for example, we have chart of British pound against US dollar, hourly chart. We first think what we are going to define is the trend. Trend is firmly to the downside. We can define it by the trend line. We can make also the channel. So it's perfect bear channel. So the price is channeling lower within this bear channel. So this indicates that the price is in downtrend. So our first thing is to define direction. We define direction. Direction is down, and most likely is going to extend lower. Now there are other factors that we are not going to talk about now, but let's move back to our trend indicators. So we are going to add one by one to see how they point, where they point, and how they do. So let's remove first our trend lines. So let's put linear regression channel. So this is the first thing that will give us the price of the direction of the market. So we have the upper, middle, and the lower line, and we can see that the price action fluctuates, and now it's approaching again the lower line. The two lines at the sides act as supports and resistances, and we can see that market fluctuates between them without breaking. So when there is no break out of these lines, meaning the trend is still alive and moving into within the original direction. Let's talk about the next important trend indicator, moving average. So let's start with the trend indicator, moving average. Let's put 10 days simple moving average as the first one. So it's a blue line. To have more indication, we are going to add, let's say, 20 days moving average. So let's put a different color. We can put also the 55 days moving average, and I will color them as my original setup is. And let's put 200 days as the referent one, as the key one, so we will know how the market will behave. Pardon. Indicators, moving average. So let's put, pardon, 200. So we have our moving averages. What we can see from these is that they track the descent depending on their number of days, so whether they are faster or slower, but they all track the general direction down. So 10-20 days moving averages are the fastest. They stay within the bearish setup. A bearish setup means that the faster one, in case of downtrend, holds below the slower one. So there was one brief break higher on this correction, but they returned back and they continue to move lower. Now they are even converging, so meaning that the trend is likely going to extend lower. Then we have next one, 55 days, which is also important indicator that gives us another negative signal. It's in steep descent and it tracks this move, so we have direction clear to the downside. Let's put MACD indicator. So we will just put darker color here. Okay, so let's just okay. MACD again is showing us strong, pointing strongly to the downside. So our indicators are all pointing lower. We can put average directional index also. So we will see how this works. This is also bearish because we have a positive and negative line, and they are moving above this dotted line. So when the red one is above the dotted line, it points to a downtrend, and this green line points to the strength of the move. So we can see it's in steep ascent. So it's it's stronger downtrend at the moment, while the uptrend, the positive line is going down. So the trend is likely going to extend further. Let's now move to the daily chart. This is crude oil chart. Let's again apply same things on this one to see. Pardon. Let's see how it works on the daily chart. So we have different time frames. Again, the price is fluctuating around the midline, so even not touching the sidelines, so staying in the strong uptrend for now and showing no signs of changing this trend. For now, there was a correction that found support above the support line of this channel, so we're still pointing to the upside. Now we are going to put moving average. Let's put 200 days. Let's put 55 days moving average. We can put 20. I don't like this color, so we're going to put green. Okay, and then we'll put finally from our setup is the 10 days moving average, and it's blue. Now, what the moving averages tell us, 200 days moving average contained this pullback. This is one of the key moving averages, so it gives us a picture of general direction. So when the market broke above this, that was a strong bullish signal suggesting that this uptrend may extend further up. Now, there was a stall and correction that stayed for several attacks. There were several attacks at 200 days moving average. None of them managed to break. So this is our reference. This is our key support. Also, we have 55 days moving average that is ascending and is also tracking the price action and also contained these levels. So this pullback. So we have signaled that correction is very likely over, and the price action is moving higher. We can use Fibonacci retracement levels to see which levels have been retraced, how much in percentage has been retraced so far, which is also very good indication. So 38.2% is our first key point. It's been broken. What we need to see today is a close above this level. Now market heads towards 50%. Usually this is psychological level. So if you take out more than a half, you start thinking that it's over. So more than a half taken out means that another half is likely going to be reversed is in the short period of time. And of course we need the confirmation and the lift above next key level, 61.8% Fibonacci retracement. So it will give us more signals. Now let's put the MACD indicator to see how it will work with this indicator. It is neutral at the moment because there was a pullback. Now it's holding around the the midline, so it's still in the neutrality mode, the MACD, so we don't have clear signal from here. But what we have good signal is break above 10 days moving average. We have a bull cross, also called golden cross, of 55 days over 200 days moving average. So this is a good support for the price action. And we have probes above 20 days moving average. So if we close today above this level, then we can consider another strong bullish signal that may push the price even higher. And let's finally take a look at ADX to see how the market, how it shows the strength of the uptrend. We can see here that blue line is still below the midline, so-called midline, which is our reference line, but is moving higher. So we have a red line pointing down, a blue line pointing higher. So we will still need confirmation here on possibility of reversal of this pullback. So we have some bullish signals, but it's still to be confirmed. So we can also refer to the MACD, which is in a way neutral at the moment. This one is gaining traction, gaining speed, but it's still we need break above this line to confirm extension higher. Now let's talk about next volume indicators. So let's now put let's go back to our hourly chart, and let's put volume. So it's levels. Okay, so volume shows us that it's still strong, and we can still expect some stronger market action. And finally, we have momentum indicators. These are also quite important, especially in the during the market trends. So let's see what we have. Momentum. So momentum is dark blue, 14 days. So let's see how the momentum is behaving. Now we have bearish momentum. We consider this 100 line as a reference. So anything below the line is negative, anything above the line is positive. Now also direction of indicator points to something. So all these move higher means that the price action regained some momentum and moved higher, but quick reversal showed this is what I was talking about, slingshot, that the small stone flew for some time and then just lost momentum and reversed down. So this was the thing. So our our general direction is still to the downside. Volume on the hourly chart is negative. And let's put another important oscillator called the Relative Strength Index, RSI. So we can also see how it works, because this is also important indicator. 70. So we're going to put. So now we have RSI at the bottom. RSI usually fluctuates between 30 and 70 line, which is sort of neutrality, and any move above or below signals overbought or oversold. At the moment, it's oversold, but it's reversing higher. So we may expect some corrective action in this case. We have signal from RSI, and even if we put stochastic, pardon, so stochastic is also oversold. First thing, we have the cross above this red dotted line, so this is positive signal. Another positive signal is a reversal, but it still needs to break above the border, the boundary of, let's make the line a bit more visible, so we can see, because these lines are our references. So what we can expect in this case, some corrective action. We have it already on RSI. Now we are adding it on stochastic. Sometimes it's not recommended to, it's basically not necessary to use two indicators of the same type, because it might confuse us. In this case, they work parallel, which logically they should go in the same direction, but to avoid confusion, so we better use only one of the type. So in case momentum or volume momentum indicators, in this case we use one, RSI or stochastic. I use both in my combination just to make sure. It's not wrong to use both, but it's not also wrong to use only one of these. So what we have strong signals of a downtrend. Bears are in play, in power, and bears are looking for a further extension lower. But what gives us indication could be this bearish divergence on the MACD, because if we follow, I think we spoke about this in some previous sessions, when the indicator starts diverging, direction of indicator starts diverging from the direction of the price action, meaning that price action is going down while indicator already bottomed and put the higher low. So indicator starts pointing higher while price action continues to move lower. So we can see that these two lines are in opposite directions. This is initial signal that something might be developing, and this is called, in this case, is a bullish divergence, so it's positive signal. So downtrend might stay on hold for some time for corrective action. General picture tells us that this downtrend is very strong, and we can expect it somewhere up to these two lines, maximum to the channel upper boundary, while anything above the channel will give a signal that this trend might be on hold at the moment. So it's quite wise to stay out of the market, because this could be signal of reversal. So simply, if we were short during this downtrend, we should take out our profits, whatever they are, in case the market breaks above this channel line, because we don't want to take more risk. Market may go a few ticks and reverse lower, but since we follow the rule and we say when we have a signal that indicates a change of our initial direction of the price, it's better to come out of the position and await for fresh signals. So once we are sure that direction, either new direction is establishing or existing direction is extending lower after making correction, then we can easily re-enter the market in the original direction. So in this case, if the market pardon, if the market breaks above this line, we'll come out of our position because it's too risky. If the market goes above, and let's say it's capped by 55 days moving average and then starts pointing lower, it's no big deal to re-enter a short position again and assume that the market will continue its original direction, which is the downtrend. Now the same things we can apply again on the daily chart. So what we are going to put, let's start part. We have lost now. So let's insert indicators. So what we are putting, MACD. Oh no, MACD we have already. I do apologize. We are going to put relative strength index. Okay, we're going to, what else is missing? Let me just take a look. Momentum. So we need momentum in this case. And we can change the color of momentum just not to be confusing us. So let's choose some more attractive color, something like this one. So momentum, in this case, we have a strong uptrend. The price is within the linear regression channel. The pullback was contained by 255 days moving averages, bullish cross, so-called golden cross form, so additionally supporting. So from the trend indicators, we have strong signal that the market may continue in its initial direction after this correction is now signaled to be fully completed, basically, and finished. What we need is close above this green line, 20 days moving average, and the Fibonacci levels that we saw previously. Now let's go to the Rsi Oscillator, which is pointing higher. So it has enough space towards the overbought territory, so we can expect the price action to go higher. Now, momentum is important. It's at important level. It's attempting to break in so-called positive territory. So 100 dotted line marks the division between positive and negative territory. So anything below marks negative or bearish momentum, while anything above marks positive or bullish momentum. And direction of this line also plays a role. So if the line is in slow ascend, it means that momentum is not that strong, although it's bullish. But if it continues in this steep mode as it was moving from reversal, this will be a good signal that the market, that the price, in this case of crude oil, has quite strong bullish momentum and is very likely to continue its uptrend. So we need to rely on our technical indicators in order to get as much as possible accurate and correct information before we enter the market. So once we have all these signals made, then it's easier job for us to make the right decision, and applying all what we spoke already, such as risk management and all these subjects from the previous classes, will greatly help us to make the right decision and to focus towards the profits rather than chasing the price in case if we get into the wrong direction and create some losses and then fail to put the stop loss, thinking that market will reverse. And this is just deepening crisis, and it's endless story, believe me. So the best thing is we follow the steps that we already went through, and this is going to greatly help us in making the right trading decision. And this will be all from my side for today's presentation. Now I would